Okay, so welcome members, welcome batch 1, batch 2 students, welcome to this session 2, ASTC Advanced Stocks and Options Trading class. Today's day is 2nd of June. Welcome to the first trading day of the month. So I'm going to share with you my screen, and as some of you noticed, the way I am doing this course this round is to share a lot of the actual screenings rather than capture the screenshots, so that I'm able to make the session as fast as I can, not like last time when I have to drag on. But before we start, obviously, let's show you the disclaimer. Understand that, okay, this is not investment advice. What we are doing here is essentially sharing with you our information, educational purposes only. Okay, so simple thing. Let's begin with session number 2. Session number 2 is about introduction to options. So for batch number 2 people, first of all, please ask questions. It's pretty quiet. I haven't seen any questions coming, so I'm not sure what the progress is. Today is kind of like revisiting the materials, and I have a case study which happened just a few months ago, showing you how we follow the rules and make money accordingly. Okay, so tonight is all options, basic strategies. We are not going to do any fancy thing. The fancy thing will come in session 3 and session 4, so stay tuned with that. Okay, so far in session 2, similar to session 1, what we are doing essentially is looking at directional trading. Directional trading means that we pick a direction, hoping that the stock will go in my direction or in the directions I want. And since the market is still quite in a bullish mode, the sell in May go away doesn't happen. We are still looking at the bullish play. Now, in the moment, in future runs, if let's say the market turns, then we of course talk about the market condition then. No point talking about bearish play when the market is going up. Okay, so bullish play, bearish play, what do they mean? Simply put, for bullish play, we are looking for a stock that we want to buy low and sell high, or some people might say we want to buy low, buy high and sell higher. Okay, so there are two ways of looking at this. Most people who associate themselves with buy low, sell high, so when the stock is high, they don't know what to do. So a refrain for that is buy high, sell higher. So conversely, when we talk about bearish play, we'll talk about selling the stock at a high price and buy it back at a lower price. So the concept is sell high, buy low, or sell low, buy lower. Okay, so it's just a definition that we want to start. And how many ways of dealing with bullish play? In this level, I would say 4. I mean, of course, there are more than that. But 4 ways of doing this are already enough. Okay, it's enough for many people to make money. And for batch 2 people, I can tell you that some of the batch 1 students, by adopting this simple rule, make quite decent money, and some have even covered their course fee. And for myself, my killer for the year so far actually came from a very simple strategy which I taught. Make over thousands of dollars just by adopting a very simple strategy. So trust the process, you will be able to know what to do with that. Okay? So we are going to look at buy the stock directly. So there's still a stock play. But after this, we are looking at buy in the money call option. I'll explain why and what exactly it is. Then we'll talk about speculative play called buy the out of the money call option. And then finally, simple vertical spread that builds the foundation for our subsequent classes. Because from the end of this point, by the end of session 2, we'll start building some complicated strategies. Okay, so it's good to introduce what a vertical spread is. Okay, so what's a long stock position? When we say long stock, essentially we are buying the stock. So when we buy a stock, we long the stock. When we sell the stock, or actually short sell the stock rather, we short stock. So the word long means buy, short means sell. That's it. That is it. So in a classic scenario, when we're looking at buying a stock and the stock goes up by $1, guess what? You make $1. However, when we buy a stock and it goes down, we will lose $1. So buy the stock, when it goes up, we make $1 per dollar move. But when stock goes down, we lose $1 for every dollar move. So what we are saying is that For a long stop position, it is unlimited risk and also unlimited reward because the stock can go all the way to 0. So that's what unlimited risk is all about. Okay, so next slide we are looking at what's a long call position. Why do we do a call option? Now, call entitle us to buy a stock, okay, at the price that is specified in the contract, okay, and what we need to do is to pay something called premium. So the whole point of doing a long call position is it will limit our risk. The risk is the amount that we pay for the option. However, when the stock goes up, indeed, that will give us an unlimited reward position. So the starting point is lots of people were not aware of the use of options. They only buy stocks. And the good news is once they know how to use option properly, that would be a very nice tool to limit our risk. In fact, there is a saying that we use options because we use it for limiting our risk. Not so much about how much money we make. It's actually for limiting our risk. What's the problem of a vertical spread then? What's the problem? The problem is a vertical spread involving buying an option and selling an option at the same time. So towards the end of this session, I will explain what a vertical call spread is. This is just a risk graph representation of this strategy, and you can see that by selling a call option in addition to buying the call option, the reward side is limited. Okay, so at this level, you don't need to know what causes this. To me, you don't need to know the whole menu before you make money. I would like you to make money first, and when you have time, study how these strategies work. That to me is more effective, more efficient play. That being said, just take note that a vertical call spread has limited reward and also limited risk. So in terms of summary of a risk-reward profile, long stock obviously gives us unlimited risk, something to bear in mind. With an unlimited reward position, for a long call, the good news is it is limited risk, unlimited reward. For a vertical call spread that has a limited risk profile, as well as a limited reward profile. So that means different way of using options or stock, you generate different kind of risk-reward profile. From a risk management point of view, obviously, we prefer long call and a vertical call spread to a long stop position, simply because going back to session one, we said that most people focus on what if I'm right, how much I can make. Whereas for us, we focus on what if I'm wrong, how much will we lose. So okay, we concentrate on the word risk all the time. So let's look at an example. I have revised the example because this is batch number 2. So I want to bring in some of the recent example. So this is a stock called SAFE, Spirit Airline. And that is an opportunity on 19th of Feb 2014. Now you guys have access to my spreadsheet. As I said last week, I actually gave you guys the access right to my spreadsheet, which I updated every Saturday or Sunday. So I just want to deal with this question just in case someone asks, where do you find the spreadsheet? The spreadsheet is in the Facebook group. Okay, so let me go to the Facebook group first. Okay, just hang on for a second. So I want to show everything just like this. I'm not going to use a screenshot. Okay, so just hang on for a while. And I'm using whatever I have here. Okay, so I'm going to my Advanced Stock Options Trading Class Alumni. You will see that under the File session, okay, File session, the spreadsheet is, where is the spreadsheet? Let me see that. The spreadsheet should be somewhere at the bottom. Okay, so this is the spreadsheet link. Okay, so this is the link that allows you to have access to the spreadsheet. So everything is done for you, and I personally have interest because for my future development, I need to keep track of all this fundamental best of the best stock. So I just want to prove to you that on the position 19th of Feb, SAFE is actually one of the best stock. So if I go back to the 17th of Feb menu, you will see that safe is under here. This passes the criteria and is a B stock. Okay, so somebody asked me when do I update the spreadsheet. For this week, I actually updated on Saturday night. The reason is that I was in a conference for the whole week, or for a whole weekend. So because of that, I updated the spreadsheet on Saturday night. Usually, I would do it on Sunday night, unless I'm busy in doing volunteering work, which I do in the upcoming few weeks. Then I may have to delay the updating progress on Monday. It happened before. So if you look at 17th of Feb tab, you will notice that safe is actually a B stock. So I'm actually using the criteria I have shown you guys last week. So I follow the rules. Now, then once I have ascertained this is a fundamentally sound best of the best stock or one of the BOB, then I go to the chart. Now it doesn't matter what charting software you use. I think I've addressed the issue many times. For the sake of consistency, I use my integrated investor because integrated investor allows me to do back testing without showing the future pricing. Pro real-time trader doesn't do this because it's free software. Other brokers platform, I also don't know whether they can do this because once again, I just want to make sure that when I teach, I'm not influenced by any future price action at that point in time. So I have a preference of using integrated investor. It doesn't mean that you have to use it. You can use anything. Okay, so long as it works for you, that's fine with me. So on 19th of February, there is an opportunity. So let me just go back to 19th of Feb and see what's happening. Let us revisit the rule of channel breakout and see whether it makes sense. First of all, if I go back to the stock chart, you see that the green line, the 55-day line, which is marked as green, okay, has been flat for at least 5 days. Good. Secondly, I also see ADX for the last 2 days. You can see ADX is slightly going up. The box is a bit unclear, but I can read for you. I can read out the numbers. So on this date, ADX, okay, on 14th of Feb, ADX was 15.30, 15.30. The next day, ADX was 1539. Okay, so 1530, 1539. So it goes up. So on this day, ADX went up to 17.47. Now the stock has not broken out yet because the rule says we need to place a buy order at the 55-day high plus 10 cents. So it has not happened yet. But other things being equal, the stock is ready to burst. Okay, so stock is ready to burst. So we will place the order based on the rule, the channel breakout rule, placing a stop at 10 cents above the 55-day high, place a stop loss at the 20-day low minus 10 cents. Because this stock is a low price stock, so we use 10 cents as the buffer. So you see, I'm explaining to you the rules that I have taught you guys in session 1. I have not deviated it, or why should I deviate in the first place? Okay, so I go back to my PowerPoint. What is happening? The rule is 52.05 as the entry price. Stop loss 43.24. So what I did was I applied the risk formula, essentially using a $100,000 portfolio, and then the 1% risk will be 1,000. My entry price, I think I make a mistake, did I? 52.05. So let me just change it. So that's why when I was not very well this morning, I was doing this stuff myself. Guess what? Things happen. So don't worry, I'm amending the slide on the spot. So this is 9.01. Okay, 9.01. Okay, that's fine. What am I doing? I don't know. But you see, if I have got $1,000 divided by 9.01, I actually can buy 110 shares. Okay, so the position allows me to buy 110 shares. 110 shares at the price of 52.05 will be 5725. Okay, so let me just change it on the spot. Sorry about that. Okay, 5725.5. Okay, so that is it. Now this is the formula that we used last week. Okay, the risk per share formula. which is the entry price minus the stop loss, equals to risk per share. Portfolio risk will be 1,000, which is 1% of 100,000 divided by the risk per share. So that gives us 110 shares. So my account has to have 5725.5 in order to buy 110 shares. Okay, let's see what happened to the stock. So on the next day, we were filled. We were in. In fact, very interestingly, the next day, the opening price. Oh, sorry, I overshot. Sorry, I overshot. I pressed the mouse too fast. Okay, sorry, coming back. Okay, so we were in. Okay, so we were in. So I want to show you on my integrated investor how it was. Okay, so we are in on this day. This is 20th. So let me just blow up the chart. You can see clearly what's going on. Okay, so the stock opened below the 55-day high. So we were actually in intraday basis on 20th of Feb. So then what we do is we will go in, wait for the stock to hit the 20-day loss, 20-day low. So you can see that the red line 20-day low remains flat, which means that I have not adjusted the stop loss until it goes up. Remember, we'll do this every single day and adjust the stop loss, and that's only our job. If we have one position, that would not take us more than 1 minute. That's the whole point. And then you see the stock continues going up. That's why I said if we follow the rules diligently, it will work. Okay. So now coming to this point, we have an issue. The issue is that ADX is about 40. Okay, this horizontal line in my chart is an ADX 40 line. We call ADX marker. Some people, this software actually call this ADX marker. But we want to watch out for this because when the stock has an ADX that's gone up 40, there are two ways of exiting then. One is when the stock hits 20-day low. The second one is when there is a B-shop. B-shop simply means ADX go up about 40 and drop. It's as simple as that. ADX crosses above 40, and we wait for the turn to wait for the downturn. As soon as we see a downtick on ADX, we exit the position straight away. That's what channel breakout system is all about. Okay, let's see what happened on the position. Okay, the stock refused to budge, continues going up, break another high. Okay, so stock keep going up, ADX never budge. So you love all this kind of position. People said, how do we find this position? Well, you know what? We have our BOB list updated every week. At the same time, you notice that my 20-day low is moving up as well. So while I'm watching ADX to give us a B-shop exit signal, we also want to watch out and move our stop loss up accordingly. So finally, if I'm not wrong, on 21st, okay, so on 21st, you see that the B-shop happens. As soon as we see the ADX line drops, that's the time we exit the trade, even though the stock has not hit the 20-day low. Okay, so that's the strict application of the system. So now I'm going back to my chart. I don't need to flash all this because I have explained to you. We just say that, okay, the B-shop signal happened on 21st of March, so we exited the position the next day when the market opened. Now, we exited the trade on next day. I used 59.95 as a benchmark. Well, of course, you may say, will it be accurate? Obviously, for my account, I'm using option. So if I were to show you this using a back test mode, I must say that I didn't do this trade using long stop position. Okay, so for options, there will be a little bit difference. But in any case, we'll exit the trade as soon as we see a B-shop signal. Okay, so that's for the long stop. So the position is like this. We enter at 52.05, not 51.95. Forgot the 9 cents. Okay, we exit 10 cents. I forgot to do this. So 59.95 minus 52.05 equals to $7.90 per share. It's quite a good trade though. The stock is just $50 and we make 8 points. Okay, so you see we have a profit of 869, not 912. So you see I'm updating this number. In terms of in terms of the percentage or return on investment. Okay, so our percentage of investment would be about 15.17%. Okay, so this is what long stock position using channel breakout as our system. We had a 15.17% in approximately 1 month's time. Okay, so how many of you would like 15% in 1 month? Okay, so that is long stock position. Now let's look at something here. So let me see. This slide shouldn't be here. This slide belongs to last batch one. Okay. So the next slide is supposed to show you the in the money call as a substitute of buying the stocks. Now we are going to look at this strategy called in the money call. Why do I call it in the money call? Let me explain. First of all, why do we even look at the strategy? Number one, as opposed to long stock, a call option eventually will give you a limited risk position, so I like that. Two, there is the ability to roll up, and I'm going to show you the roll up thing for this particular position. And also, this position allows us to have a risk-free trade, which means that whatever we have invested in the option, we actually took all the risk out of from the trade. The trade is actually risk-free. And my mentor ever said, there's only one strategy that can generate a risk-free position, not stocks. Not stocks, it must be option. Because options roll up can help us lock in profit, create risk-free trade, and I'm going to show you later how it works. The problem of this kind of strategy is many people say, okay, now I know there's such a thing called in the money call option, but tell me which strike do I buy, which month do I buy? Regrettably, I do not have the formula for you. I don't have the exact scientific formula or scientific proof for you. So it's always an art, not a science. But I do my best to give you the guidelines based on the current market condition, because obviously a few months ago the market condition is very different from what we experience nowadays. Even though it's still a bullish market, the degree of bullishness has changed. So I'm adjusting the guideline as a result of that. That's why I keep saying that this is an art, not a science, because my guideline can also change. Okay, so option B and ask can be wide because we use in the money option. Because most people, most options trader actually would buy at the money or out of the money option. So because of that, the demand for in the money option will be low, and that also means the slippage can be wider. Okay, and slippage is actually a cost of doing business, so we do want to minimize the slippage. The best deal of this is we are looking at IBD 50 stock, so to a large extent, there will always be some demand for the options for these IBD 50 stocks. So the slippage is not very big deal based on my experience. Okay, so here are my rules. I call it version 2. First of all, rule number 1 remains unchanged. You must have a stock that is optionable. For example, I give a name of a stock. I haven't checked the account whether it's still true because I copy last batch slide. ANFI, for example, is not an optionable stock. Okay, ANFI is actually one of the IBD 50 stock, but it's not an optionable stock. So if it's not optionable, then cannot do anything. What you want to achieve is you buy a call with at least 75 delta and with at least 21 days to expiration. This is because of the current market condition. We are now experiencing a moment of low volatility. The market is quite quiet in that sense. In fact, the last time we saw this environment was 2006, second half of 2006. That was the time when VIX, CBOE volatility index dropped to 9. I haven't seen it for almost 8 years already. So because of that, I'm okay with 21 days. I'm okay with 75 delta. Just to make sure the batch 1 student understand, I mean, I'm not giving different information. I've told them to use 30 days to 60 days. And I've also told them to use 80 delta. Okay, for batch 2, I'm telling you now 75 delta, 21 days. The reason is it still works. very nicely in the current market condition. When there are any substantial changes to the rule, I will let everyone know. Okay. So what happened then is we'll roll up. I will not say roll up is a must, but you consider rolling up your option. I will tell you what rolling up means. So that as soon as you see a delta, you bought the option with delta 75, now it reaches 90 delta. 90 delta, I will explain what is 90 delta later, so don't worry about this. This is a little bit technical jargon, unfortunately. And we'll roll up the call to take some profit off the table, lower our risk. That is what essentially the key aspect of this strategy. We will also roll out the call option during the expiration week when we are still in the trade. But we have to make sure that by rolling out, we keep our option delta at 75 and above. The trade safe, the SAVE happens to give you both roll up and roll out scenarios. So I found this example perfect for teaching purpose. We'll continue doing the roll up, roll out until the CB or TA exit rule happens. Okay, so currently what we are doing is we are just following all these rules. I would make some adjustment here. Consider to roll up because there is an exception to this rule. The exception to this rule is that if you don't see any good roll up, you just keep your delta like this. You don't need to roll up for the sake of rolling up. I will explain to you in the safe example later as to why this is the case. But roll out is a must because when we say roll out, in other words, we are selling the options of current month and buy an option of the next month. If we don't do this, expiration Friday, guess what? The option that we have will be exercised. So you don't see the options position, instead you see stop. That will violate the entire position. So roll out is a must. Roll up is not. Okay, keep that in mind. Okay, so the next thing I would like to show you is jargon. What are some of the jargon? Unfortunately, when we deal with options, we have to have some jargon. So what's call option? Call option is a right to buy a stock at an agreed price on or before expiration date. This is a very straightforward definition. When we say in the money, what do we mean by that? In the money, simply put, when stock price is at $55, okay, stock price is at $55. The price that I agree to pay or to buy the stock is 50. So strike price is the price that I agree to buy the stock. And if this is lower than the current price, that means the option has intrinsic value. Out of the money option is the other way. The strike price is 50, but the current price is lower than that. So what we are saying is that these options, out of the money options, have no intrinsic value. Okay, so that's something that you need to know. Now I'm going to use SAFE as an example, showing you how it works. Now, as of 20th of Feb 2014, okay, the March option has 29 days to expiration. Okay, so if I were to look at a 75 delta for options analysis, we go to the options data table. So let me show you how to do it. Okay, so I'm going to options analysis. Okay, so turning back to 220. Okay, so I decided to do this, which will give you a faster play. And I have tested the platform using Safari. Surprisingly, Safari works better for options analysis, whereas Google Chrome give me some problem. So on 220, I'll call it 220. The Feb option has only 1 day left, so obviously it's not our choice. Okay, so we are going down to the has 29 days. Now we will use the March option because the next set that is available is June 14. Now that has 120 days to expiration, so it does not make sense to buy June option in this strategy. So the obvious logical choice for this strategy is to look at the March option. So the next thing is I'm going to this table called Delta, which is marked in green color. So let me blow this up and you'll see what's happening. I'm looking at Delta 75 and above, so the magic number is 75. So this one, you see at 781, 67.95, that's the delta for the bid price and the ask price. Now you can just take an average, so somewhere between this number, the midpoint will represent the delta that we are looking for. So I would say that this is around 69 delta. The next one, which is a 45 strike call, you see that the delta is way above 75. So this must be the one that we pick, okay? And for that, in safe situation, in safe because IBD 50 stop, if I were to place 765, somewhere between 765 and 790 for this call, I will be filled. So that's the whole point. So now I'm going back to my table. So I actually have done a demo in this trade. So I want to call back the trade that I have, ASTC. This is what this trade safe. That's true. Okay. So let me call back the risk graph. I've also printed a screenshot for you. So don't worry if you cannot follow this. It might be too small for some of you. So the demo is to use the $765, and I'm going to buy one contract. Now let me explain why one contract. So go back to the PowerPoint first. What happens is that if we were to use a long call option, we want to still start off with the long stop position analysis, which is this slide. So what happens is this: for US stock options, every contract that we buy controls 100 shares. So this strategy will work. Okay, this strategy will work if, let's say, the number of shares to be bought in this case is 110. So in other words, we will buy one option contract, which we cannot control 110 shares. That's okay, but at least we can control 100 shares. Now some of you may ask, what if the formula gives me 99 shares? Okay, then I'll forego the opportunity using options. If I were to use long stock to do this, I'm fine. But I will never ever use option. The minimum of this number must be 100. Otherwise, we'll be wrong in our leverage. Okay, so I'm very strict on this. This must be 100 and above. Okay, so that's the reason why we buy one contract, one call. So this is what we have got here. You can see in this slide I said June doesn't make sense because June has 120 days. So we stick to the March option. So the choice of months, March, the choice of strike price, we'll use a 45 call with a delta of at least 75 and above. What's delta? Delta essentially is to measure the sensitivity of the change in the options premium to a change in the stock price. So let me speak in English what it is. It says that essentially the options will drop every 75 cents. Okay, options premium will drop for 75 cents for every $1 move of the underlying stock to the downside. Okay, other things being equal. Whereas if the stock moves up $1, our options premium will go up by 75 cents, other things being equal. So that's what delta means. So we cannot get a dollar for dollar move like stock, but we sacrifice that portion for limited risk. So yes, there is a trade-off between the dollar for dollar move. Don't forget we have got a limited risk as a result of using options. So that is a very logical trade-off, if you like. So I'm going to do a series of sharing with you the screens, but I do have the slides, screenshot for all of them. So don't worry if you miss anything. Okay, so I'm going straight to the position and show you what happened on 24. Okay, so the first milestone is 24. And what I saw was the stock goes up, or went up in this case because we do back testing. Okay, are we done here? Okay, so the stock has gone up. Okay, the stock has gone up nicely. Now, we are going to use the theory of doing this thing called roll up. So what do I mean by roll up? So in the first place, why do I do roll up? That's because if you go back to my slides, Okay, going back to my slides, 24th of Feb, what I said was, okay, the option has already hit 75, has hit 90 delta. So how do I prove that? Okay, how do I prove that? So what I'm going to do is I'm going to open the option chain. Okay, I'm going to open the option chain to show you how to do this. Hold on for a second. Okay, so I know I need to go to displays options chain 24. Okay, so the March 45 call, as you can see, I've got like a 95 delta. I've got a 95 delta. So what I'm going to do is I'll roll up the option. When I say roll up, what does it mean in English? In English, it simply means that, let me just change the leg day so that you see how it works. Okay, so hold on for me. I'm rolling up and down also. Sorry about that. I just want to make sure that the legs are shown properly. Okay, so here's what we do. What we do is essentially sell the 45 call. Okay, and buy the next call are available. And as a result of that, we reduce our delta from originally 95 to now a number 85.62. Okay, now think about this. Can I roll up to 55 call? Yes, I can. But the stop price is also 55. So I can imagine if I roll up the call to 55, this 55 call will not give me a 75 delta. So because of the limitation of the option chain, I had no choice. I can only roll up from 45 to 50. So how do I do this? I sell the March 45 call and buy back the March 50 call. So as a result, you see that the risk is down from 765 all the way to 295. So we have carved out almost like $500 of risk, which is good. Okay, and now we have an unrealized profit of $280. So that's the position. Now I'm going to move to 227, which is the next milestone, and I'm going back to the slide first. Now for the next slides, I said that okay, I see my delta has gone up to 93. So let me go to this screenshot. You'll see that my delta on 27 is 93. Hello, too much. Because when you see the delta has exceeded 90, you've got to reduce it. So what I'm going to do is I'm looking for rolling up. Okay, so here is what the screenshot helps me. Okay, it's a bit small, so I'm going to blow this up, and you see that the delta of a 60 call. This is a 60 call. Oh, sorry, 55 call. My bad. 55 call. The delta is only 63. So if I were to roll up the 50 call to 55, my delta is only 63. I need 75, so I cannot roll up. Because of the option chain's limitation, I had no choice. I have to stick to this 93 delta option. Okay, so my objective is okay. So I'm hanging on to this call. What can I do with this? Nothing. Okay, so there is some limitation of the chain that allow me to roll up. Okay, some of these stocks are weird stocks, and they are like that. Okay, so because of the limitation of option chain, I do nothing. So I'm going back to my slide. Okay, maybe back to my slide. I am moving up to 5th of March. So I'm going to 5th March to show you the screenshot, to show you the actual risk graph better. Okay, so 5th March, what I did was, okay, I saw the delta. Okay, now 5th of March, I was able to roll up and reduce my delta to 82. Good news. How do I reduce it? Okay, let me explain. I sell the 50 call, I buy 55 call. That is it. I sell the 50 call and buy a 55 call. So that is what you do with your broker. If you're not sure how to do it, ask your broker, because your broker must tell you what to do. Okay, I cannot tell you what interactive broker will ask how you do this in IB, interactive broker. I cannot tell you how to do tell you how to do in Option Express or Trade King. So the best way of doing this is to check with your broker to let them teach you how you roll up the call. But rolling up simply we sell the existing call we have, buy a call at higher strike. End of story. So now with this roll up, you see I've got a minimum profit of 165. This trade cannot fail. This trade cannot fail because I have already a minimum profit of 165. But my unrealized profit is 595. Okay, so we have actually $430 risk, if you like, on the table. We have minimum 165. We have now 595. So if stock goes to zero the next day, we will effectively lose $430, keeping our $165 intact. Okay, so that's the analysis of a minimum profit position. We call this the risk-free trade. Let's move on to the next milestone. The next milestone is 12th of March. I wanted to roll up to 60 call, so let me show you on 12th of March, a week later, what happened to the position. On 12th of March, I would love to roll up the call because on 12th March, the delta is 90. Okay, it's a bit much for me already. So I look at the chain, I said, okay, can I roll up? So I've got a snapshot for you, which I'm happy to roll to turn it higher. Okay, turn it bigger. You see that my call is a 55 call. I could have rolled up to 60, but the 60 call gives me a delta of not even 50. So it totally doesn't make sense to roll up the strike. Okay, so what do I do? Nothing. Okay, so I'll keep my 55 call. As the story goes, the next milestone is 17th of March. What is the significance? What is the significance of this date? That is the expiration Monday. That's the expiration Monday. So remember I said during the expiration week, you've got to plan rolling out your option if the CB system has not given you a sell signal yet. Okay, so what do I do on March 17th? Let me check. Let me share this with you. So for March 17, what I've got is a roll out, not a roll up. Remember, roll up is optional, roll out is a must. I have only 4 days to go anyway. So what I did was I have selected an April 55 call and April 55 call. So essentially, my position is roll out from March to April. Okay. Now, why do I choose 55 call? Because I look at the delta. 55 call gives me at least 75. Okay, it gives me at least 75 delta. So does it mean that I must roll out at the same strike? No. Your job is just to find a call option in the month of April, in this case, that has a delta of at least 75. So in the absence of doing things, it just happened in this case that the roll out give me the same strike. Okay, it doesn't mean that in real world or in other trades, the strike price must be the same. It happens to me before. The 55 call can be a 52.5 call. A 55 call can be a 50 call. So it really depends on the option chain. Okay, so that in any case, I have now 32 days to go. My unrealized profit is $750. My minimum profit is down to 100. You may ask why. Because I have rolled out the option, which has to cost me money to do that. So I'm using part of the guarantee profit to subsidize this call purchase in that sense. So therefore, my minimum profit is now down to $100. So if you remember in our earlier example, I said, well, we are going to exit on 21st, right? But before this, what is interesting is that on 19th of March, I've got an opportunity to do a roll up. So let me see. I would love to, but again, due to the option chain limitation, my delta is already above 90. I could roll up, and I cannot say that, oh, if that's the case, I better exit the trade. Okay, that's not fair to people who don't know the future. In any case, I don't know the future too. So I cannot say at this point, oh, let us take the risk, take the trade off the table, knowing that we have made so much money. By saying this, you are not following the rule because the CB exit signal has not happened yet. Okay, so what I'm going to do is to consider if I am able to roll up. So going back to my PowerPoint slide, I believe I've snapped a picture for you. This is what happened. I could roll up the strike to 60, okay, 60 here, but the delta is less than 75. In fact, it is just 70, so not good enough. Again, due to the options chain limitation, I cannot roll up the call. So then I'm waiting for the final signal on 21st. And what happened was, okay, that's the day when I had to exit the trade. Now, for the back testing, I am stopping here. You see that finally we make $655, okay, out of the original investment of 765. Okay, so let's come back to the slide. All legs are closed. Well, the last one was pretty sharp, and that's why the B shot happens. But that's okay. At least we make $655. Now, let me explain how it works in terms of the long stop versus in the money call option. Okay, so all the screenshots are there. You can have access to that later when I upload this to the class page. Now I'm going to make a comparison. Now the comparison obviously is not fair in the sense that these numbers are no longer true. My initial outlay is 52.05 times 110 shares, so it's not this. I forgot to change the number, 5725.5. Okay, so I have made a profit of, I believe it's 59 point. Sorry, I have to go back to the previous slides and see what is my dollar profit again, if you don't mind. Okay, so mine is 790. 790. Okay, so now I got you. 790. That's the one. Okay. Let me push it back. Okay. So I've got $790 of profit per share times 110. That is 869. The return on investment is 869 divided by 5725.5. That is on the that is, hang on for a minute. Okay, that is on the, no, that should be, there's a return on investment should be this one on the initial outlay. On the initial outlay, it simply means that is the profit divided by the original, the amount of money that I have to put up to have this trade. Whereas return on investment is actually 86.9%. Why? Because our risk is measured at 1% of $100,000. So this is just the number game. To me, what you will focus on, to me, is always 15.17, because that's the amount of money you have to put up for this trade. Okay? Whereas for options, what you see is I only need to fork out $765, and I have a total profit of $655. So my return on investment is 85.6%. Now I'm doing only one contract, so you may say, well, one contract I need to put up only 765 only. Yes, that's why option is a very nice leverage tool. But you must know what you do. For example, some people will say, oh, instead of spending 5725.5, I only spend 765. Let me divide 5725.5 by 765 so that in this case I may buy 7 contracts instead. No, you don't. That is called over leverage. If the position says buy 110 shares, you buy 1 contract. End of story. Do not think, oh, because you only spend so little money, you can buy more contracts. That is called over leverage. Okay, please do not do that. Okay, understand that if you have 7 options contract, how many shares you are controlling actually? 700 shares. Can you afford that position? Some people don't know this, so I want all our students to know that if this is 110, based on the formula, you only buy 1 contract. Batch 1, I have an example telling students to buy 3 contracts or 2 contracts. But in this position, because of the price, we only have 1 contract. That's okay. Don't worry, because we are just applying the formula. So if you have any questions about not sure whether this formula gives you how many contract, just ask in the Facebook group. I'll be happy to answer such questions. So let's move on to the next concept called out of the money call option. Now I would say that this is called using options to trade stocks. We're using options to trade stocks. This is the classic approach of options trading. And the reason why I say this is you've got no idea what to pick in terms of the strike, in terms of the expiration month, because you are not using options as a substitute of the stock position. You're actually using options to trade the stock. So notice the phrases I'm using. This one requires you, in my opinion, the use of options analysis. Now, some of my students are optionetic students. So they use Platinum, which is a super expensive program. For US $120 a month, they have access to Platinum. Whereas you guys, batch 2, if you only spend $15 a month using a promo code, you get almost everything from Optionetics Platinum. Now, please do not tell your friends about this. You will get me into trouble. I'm dealing with a very closely connected groups. So help me out. Just keep it yourself. Don't tell any other people. Otherwise, I'll be in trouble. But I'm doing this for you guys. Promo code 50. Promo 50. You pay $15 a month. How do you do it? You just need to subscribe. PayPal will charge you every month $15. Now, do not tell me you cannot afford $15. That is what we call business cost. If you ask, must I do this? Well, in session 3, you will understand why this $15 pays you or is worth. $15, you can generate 2 zeros behind. Okay, every month is possible. So please do not think penny, think pound. Okay, so this is my advice to all of the students here, whether you are from batch 2 or batch 1. So next thing is we need more time to be right. Out of the money option, the only one thing I'm worried is that we need more time to be right. We cannot have a case of, okay, using only 21 days, okay? Just like in the money options, we say at least 21 days. For out of the money options, we have to have at least 90 days. We also need to know what option, what strike price to pick. The whole point of this strategy is if we buy a call option, say for $1, I want to sell it at 2 so that for every dollar I invest, I have $1 profit. That's called double the money. So if I pay $1, I want to sell the option at 2 so that I can profit of 1, double the money. So that's the only objective. So it has nothing to do with the stop price, technically speaking. So what do I do? First of all, these are the screenshots for options analysis. Keep in mind that the option analysis have lots of videos. Okay, so there are also some features where Platinum do not have. So free video allows you to have a quite a solid understanding of what this is about. Now, how do you click this? I'm going to show the video version. So allow me to go back to my options analysis. I'm going back to 220 first, okay? I'm showing you in terms of the interactive way. I have also the screenshot for that. Now, first thing is you will all, when you log in, you will come to this site map, or called the standard page. Okay, so what you need to do is go to options, data, option chains. And please give me, don't tell me I cannot access to it now. Okay, let me do it one more time. Uh-oh. Even Safari give me some challenge. Sorry, the machine hang. Somehow the machine seems to hang. That's why if I want to show this way, I also make sure that I have the slide, the screenshot for all of you. Otherwise, I'm embarrassing myself. Last week, some of you know that I've embarrassed myself quite many times, right? Because of the technology issue. So, okay, let me do it again. So, options, data, option chain. Now, you need to go to the symbol you want. So, my symbol is save, S-A-V-E. So, I just need to click update so that now the stock ticker symbol is reflected as save. Okay, so now save. You will want an option that has 120 days. Now, 120 days by all means is a guideline. Now, in this case, let's think about it. I've got 4 choices. I can choose to buy 21 days. I can choose to buy 49 days. I can choose to buy 112 days. I can choose to buy 203 days. 21 and 49 are too short. 203 are too long. So if you say 112 cannot, I don't know what to say. If you apply the rule, yes, 112 days are too far away. Sorry, 112 days is not too far away because we are looking at 120 days. So I will ask you to exercise some flexibility here. Well, 8 days only, no big deal. We can handle that, right? So if you decide that September is your choice, you just need to make sure that this percent to double button or radio button is checked. And then you go down all the way to the September option, which is here. And before that, I also want to mention one thing. Your job is to make sure that the options gives you a sufficient range, because here strikes are limited to only 10% from stop are limited to this percentage from stop close 10%. So the option chain is not complete. So I want to make it 999 so that you see the full option chain. So then now you see the option chain is a bit longer. Okay, I'm going to the the September option that gives me 112 days. What I need to do is essentially pick under the stop P to double bid and ask. Okay, what I need to do is to look for this particular case, the yellow box, and that's the box that gives me the fastest to double strike price. So it says that if I were to pick a 60 strike, the stock needs to make about 15 to 16% to double the money, and you see that the price is wow, $4.50. Or the price of the option is somewhere between 425 and 450. Okay, but is that okay with that? Of course, it's entirely up to you. Okay, so I just want to key in this, and I'm going to show you how it looks like. Forgot to change the date. Have I changed the date just now? Let me see. In terms of the screenshot, did I forget to change the date? Oh boy, sorry. Let me say again. I forgot to change the date. It's 5:30. I should have changed to 2:20. No wonder my numbers are a bit funny compared to what I did this morning. Okay, so let me. Sorry about this. This is my screw up. Okay, let me say again. You need to make sure that 999 is shown so that the whole chain is up. You need to make sure the percentage to double button is checked. You also need to make sure that the date is correct. Okay. So now with these 4 sets of tables, or 4 sets of what we call the expiration month, do you buy Feb? No. Do you buy March? Too short. Do you buy September? Too long, 211 days. So June makes sense, right? June just nice. Day expiration is 120 days. Okay, it happens just nice. So no dispute whatsoever. So I'm going down to the June option. June option. Looking at stop PCT to double, stop percentage to double. You see the yellow box here. So you just need to buy one of these. One, in this case, a June 50 call option. A June 50 call option, and that's good enough. Okay, so you see that I have actually created a table. So you don't need to see this. I'll open up the trade that I've saved. That would make a lot of sense. Sorry about that. So let me go back to the trade that I've saved. So you see this. Okay, so my trade is saved back to out of the money call. So that's the one. Let me open the risk graph. So on 2/20th, I have the CB signal. If you believe that the stock price works for you, I mean the stock is going up, CB signal says so. This is the options that you can pick. 580. You pay 580, so obviously you need to sell the option at $11.60 in order to clock the $580 profit. So eventually the stock can double the money or has doubled the money. And when did it happen? So these are all the screenshots showing you what I've just done. Okay, so you bought a June 50 call for $580, and on 17th of March you have doubled the money. So from a CB trade perspective, you exceeded the trade on 21st of March, or actually 22nd of March. For out of the money option in this case, you know what? You exceeded the position a few days earlier. Okay, so you have sold the position at 11.60, having a $580 profit. Now I've actually run through this, tested it, making sure that it works, to make sure that these numbers are correct. I have some thoughts for you. These are my challenges. People always ask, I don't want to speculate, because I don't know if I win all the time. First of all, losing money will happen. So this is just another way of playing options. Some people just like to gamble. Some people like to bet. Some people like to show the world they are good at picking direction. So you and I have different trading styles. So I won't say that one is better than the other. Just understand that for out of the money options play, it is highly speculative. Your chances of losing money could also be high because of the speculative nature of this. And what is crucial is you do need to follow your plan. If you see that you have double your money, exit the trade. Don't wait for a few more days, okay? Because you know what the market knows. The market knows when we don't follow our plan. At the same time, there are some things that I would like to talk about. This trade has 580 of risk. What if you lose $290? What if you have lost 50%? So, okay, what if you have lost 50% of this? You better get out. So my only simple rule is, if you see double the money, you exit. If you see you lose 50%, you also exit. Okay, you are not going to think too much about this. So personally, people, if you really have to ask me, so my answer to you is still the same. I do not like to gamble. I do not like to speculate. So I personally prefer IPM call. I personally prefer ITM call. Okay, that's my personal preference. Okay, so between out of money speculative way play versus the in the money call, I like in the money call. Okay, so that's my answer. Now let me go to the fourth strategy. My time now is 9:34. The market has already opened, but I don't care. That's the beautiful thing about trading options. I don't need to watch the market. And we are now talking about using call vertical spread. Buy to open a call at a lower strike, sell to open a call at a higher strike using same expiration month. So in essence, this is how it works. If you use Jan as the expiration month, you will buy the stock option at a lower strike, so say 50 call. You will then sell at the same time a call option, same month, at a higher strike. That's it. That's what a call vertical spread is about. you will initiate this spread as one trade with 2 legs. In session 4, you will see we initiate one spread, as one trade with 4 legs. Okay? In session 4, we have 4 legs trade. Session 2, session 3, we have 2 legs trade. Okay? So we are not concerned how much we buy the option, how much we sell the option. In other words, I don't care with the breakdown of the prices between the 2 legs at all. When we sell the spread, we sell it also as one trade. So whatever we buy to open, we sell to close. Whatever we sell to open, we buy to close. Do not sell them piece by piece. Never ever do that. Okay? So, how do we trade this? Not how do we trade this. How do we do this? There are some judgment and probability, I must say, to be involved. So, the question I asked going back to say 21st of March is, do you believe that the stock will be about $55 by March expiration? Do you believe? So how do I prove that? Well, if you look at the March option chain for SAFE, there are 3 things I can do. If I'm buying 50 call, that is, let's say, the starting point. If I choose to buy 50 call, I can sell 55 call. I can sell 60 call. If I buy a 55 call, I can only sell 60 call. So these are the 3 combinations. I have illustrated the criterion for you to consider. If I were to sell a 55 call, I have to expect SAFE will be above 55 by March expiration. If I'm selling a 60 call, then I need to have the expectation that SAFE will be above $60 by March expiration. So, for a vertical spread, this is the risk-reward formula. Essentially, the risk will be the amount you pay for the spread times number of the contracts times 100. The reward is always the difference between the strike prices minus the premium you pay times number of contracts times 100. So using the example of Jan 50-55 call spread for $2, your maximum reward is $300. Because your risk will be 200, your maximum reward will always be 300. So I'll let you read through the slides. To me, the whole point is, if you are selling a call, please understand that if it only gives you 5 cents or 10 cents, we say it's not worth selling it. So forget about selling a spread. For selling a call to create a spread this way, the premium is just far too low for us to do. I also want to introduce the formula called expected move. Typically, that's the market maker's ways of looking at the probability. So essentially, we have this expected move. If you understand statistics, those of you who have been to PSLE in Singapore, you know what expected move is. That's the that's the T-score. That's the bell curve. Okay, so people from Singapore, you know what I'm talking about. So people who are not from Singapore, you may not understand what it is. So essentially, it says, okay, if I were to plug in a couple of informations here, so stock price is 52.4. The implied volatility, which I can see from the options chain, implied volatility simply talks about the sensitivity of the options to the volatility. And I've got a bid, I've got an ask, so I take an average. So the average in this case is 0.3662. I have 29 days to go. So I'm going to plug the variables to this expected move formula. I get $6.50. So in English, it says that the stock has 68% chance, theoretically, of trading between 45.90, which is 52.4 minus 650, or 52.4 plus 650. So that is 58.9 by March expiration. So from an expected move formula perspective, the stock is expected to reach 58.9 in 29 days as one of the probability ranges. So that means 60 is out of the question. So better sell 55 instead. Okay, so I use expected move formula to tell me which strike can be sold, which strike cannot be. So in this case, since the upside is 58.9 only, no point selling a 60 call, because a 60 call I need the stock to be above 60. Doesn't make sense. Okay? So in other words, I'm going to just simply put a 55 call spread. This is how it looks. And this is a $245 trade. The game is very simple one. The plan is if we stop out based on the CB exit rule, we are out. If the spread lost 50% of its original value, we are out. Otherwise, we will hold on to the call, or hold on to the call spread. And say, for example, during the expiration week, we do need to watch out the position carefully. So long as the stock is above $55, I don't really care. I will just let the whole trade expire in the money. And what it means is that the broker will help you to settle the options. You will just pocket the difference or pocket the maximum profit, which in this case you will see is $255. Because you risk for 245, this is a 5-point spread. 5-point spread, that's $500 on table. So if I pay 245 for maximum risk here, my maximum reward has to be 255. So my point is, if the stock is above 55, I basically do nothing. Okay, so honestly, on 21st of March, the March expiration day, the stock is way above 50. So I just let the position expire in the money. The broker helped me to clear the stock position, and as a result, I pocketed the difference of $255. So it's a very simple way of doing. But the point is, do you want to do this? So there's always a reason why we do it, why we don't do it. The reason why we don't want to do it is because it is a limited reward situation. Cause vertical spread gives us a limited risk and limited reward potential. And the keyword is limited reward. So that means if the stock shoots up to the moon, I will still have a limited reward. Of course, you might say, how do I know? But what if you know? So sometimes you do need to understand that by doing a vertical spread, while it is easy to administer, you actually have sacrificed the unlimited reward potential. So it's something that you have to live with. So long as you understand this aspect, this strategy is fine. The spread needs sometimes to be right. You cannot expect, okay, the expiration day is, you know what, tomorrow. So I put on a spread, hoping the stock will go up to the strike that I've sold. You need the time, you need some time. Obviously, not too long, not too short. So in my example earlier, March is okay. June is a bit far, okay? So this stock has March option, and the next month available is June. June to me is a bit far, so I am happy to live with March. So that's why all this picking up the strike, picking up the options, pricing, really is an art. I hate to say that. Do I have specific formula to show all you guys? No, I don't. But if you have any questions, please ask. That will help me to help you. Okay, so I have gone through 4 strategies. So they are: number 1, buy the stock; 2, buy in the money call; 3, buy and out of the money call; 4th one is do a call vertical spread. So I have 4 strategies which are enough, in my opinion, for people to make money. So don't worry about knowing all the fancy trade, fancy strategy at this point. Things work, make money first. When you are too bored by making so much money, yes, then you consider doing other funny things. Okay, that's my opinion. Now, let me talk about bearish play on ETFs, index or ETF option. Now, the situation occurred this year a few times. I used the Jan example, which is essentially the one that I've shown to the batch 1 students, because that was a very classic example. And I said, number 1, when you have a lot of stock in your portfolio, or for that reason you own a lot of call options, guess what? If the market turns, in other words, if the market goes down, your portfolio may be hurt. So we want to adopt something called precaution rather than reactive method. Precaution means that we will hedge or protect our portfolio with the use of index options or ETF options, whichever the case might be, to buy insurance for the portfolio. So the idea is, if you are looking at Dow Jones Industrial Average, there are things called DIA, which is an ETF, and for the index options is DJX. That's optional. For Nasdaq Composite, the one that I don't really look at, because Nasdaq Composite is not tradable. So why do we look at something that is not tradable? So I have not looked at Nasdaq Composite all a while. Those who follows me on my weekly market review posted on YouTube, you will notice that I never talk about Nasdaq Composite. I only talk about Nasdaq 100. By the way, if you have not followed my weekly video, it's no longer called Saturday Fever. It's called Options Trading Hangout. For the equity and futures part, I have created a separate video called Forex Trading Hangout for the forex market. So every week I have 2 videos up, just to talk about the stock markets, futures market, and as well as the forex market, all free of charge. Okay, so Nasdaq 100 is the one that I track. So for ETFs, triple Q, for the index itself, and DX. SP 500, we have got SPDR for ETFs, and SPX, which is the index. Russell 2000, the small cap, we have got IWM for the ETFs, and RUT itself for the index options. Now, here's my take. If you are familiar with equity options, then trade in ETF options. You are not ready to trade the index options such as DJX, NDX, SPX, and RUT because their expiration cycle, the way they are settled, are different. Okay, so to make things simplify for all of you, just trade SPY, SPY, enough. Okay, I don't even want you to trade things like diamond, okay, or triple Q. Just focus on SPY, SPY, simple. Okay, your portfolio will be nicely hedged. Okay, that's what I do, by the way. So why trade ETF options? 2 things you do in this market conditions, because we do quite a lot of long or buy trade. We want to buy insurance. Okay, so the first reason why we trade index option is when I see my portfolio is very, very long, in other words, very, very bullish, and I believe that the market might turn anytime, I will start loading up SPDR, SPY. That's what I've been doing. In my portfolio, I lost a lot of money on SPDR. I lost a lot because these are all my insurance, which is fine. That's why I say use SPDR to hedge your portfolio. Lost money on insurance, perfectly fine, because you make money from the stocks. If you make money on SPDR, then I worry about your other positions. Think about this, because SPDR is a insurance play. So what do we do by going back to the Jan condition? January condition, as I show the batch 1 people, I've seen that the line has been broken. There are a couple of ways of noticing this. This one is a simple bullish support line broken scenario, so you just join the few points. You see that the line finally was broken. The other one, I don't know whether you follow me. I mean, I actually talk about this in a few ways. Number 1 is sometimes my options trading hangout video, I will talk about this. For example, if I look at, let's say I go to Dow Jones Industrial Average. Okay, so I'll go to the weekly chart. You see that the index is very bullish, right? But just recently, the index is slowly consolidating. But this is not the point. The point is you just plug in a stochastic divergence. Sorry, not stochastic. My numbers are 1433. Okay, this is called stochastic bearish divergence. So what I need to do is this. Okay, I'm looking at stochastics. If I see a high, I see a high. Good. If I see another high, does it give me a new high or the other way called a lower high? So you see that the market has already given us some indicator of stochastics bearish divergence. Now, bearish divergence happens or work well only on weekly chart. I don't use daily chart on that. Okay, so I'm looking at this. So every week, what I do is that to check if there's any stochastics bearish divergence. So recently, as you know, Dow Jones make a new high. So this is not so accurate. So I move the high here. Do you notice that there is still a lower high? Higher high on the chart, lower high on the stochastic. So the bearish divergence is still there. So when I see bearish divergence, it doesn't mean the market will fall or tank. It just simply means that I am very willing to hedge my portfolio. I'm very willing to hedge my portfolio. When do I do it? Well, I'll just wait for some indication that the index will drop. Okay? So that's the way I am doing now. I'm waiting for divergence to play out. It doesn't mean it will come today, tomorrow, or next week, but when it comes, I'm ready. Okay, stochastics bearish divergence is coming, very scary thing. Now, if you want to know this, please follow my options trading hangouts video that I posted on YouTube, because sometimes I do talk about this. A lot of gems are actually from the options trading hangouts video. I don't know about you, one of my subscribers actually make a lot of money by just watching my options trading hangout. That's what he told me. I don't know what he did. He just told me that by watching a video, I made a lot of money. Okay, so there are gems there. I don't even know. Okay. Now we have got the situation on 23rd of Jan. The trend line was broken. So what did I do? In this case, I use diamond. Okay, in this case, I use diamond. Can you use spider? Of course you can. You can sell short diamond itself, which is an ETF. You can sell contract of difference, which is a CFD, contract for difference, if you know where to find it. Okay, I'm not a CFD guy, so I don't know how to do it. You can buy out of the money put option on diamond. You can sell out of the money call vertical spread on diamond. Now, what I want to show you is the buying out of the money put options and also sell a call spread. So I keep it short and sweet. We have 7 minutes to go. We should be able to finish everything. So what is a put option? A put option is the right to sell an underlying at an agreed price on or before expiration. Essentially, this is the reverse of a call. That's why call up, put down. At the same time, this is the right to sell, which a lot of people find it very hard to understand, because right to sell, what do you mean by that? Well, think about insurance. Think about insurance. If your car is crashed, your car's value is now 0, but you have a right to sell your car at 10,000. Isn't it good? And how can you do that? Because you have bought insurance for your car. So we always equate this concept with insurance. That would make a lot of sense. You don't want to give a lot of time for the position. Now I say 21 to 45 days. Typically, I would even want to look at 30 to 21 days to 30 days. Okay, because when the stock drops, it drops fast. So I don't need to buy insurance for 45 days. If I can buy insurance for less amount and give me the best payout, I would choose a shorter term. The thing, however, is that if I give you a very short duration, then what if the insurance doesn't work out? You may blame me. So to protect myself, protect you, I say 21 to 45 days. Typically, I'm looking at between 21 and 30 days. And use out of the money, the strike that allows you to double the money, or sometimes I'll just conveniently look at the option with a delta of around 30. That would be the good options to buy. So double the money or 30 delta. put option. That's it. I keep it very simple for you guys. It's like insurance premium. So put, if the put option doesn't work out, it's good. That means your long stock or long options, your call options are working for you. So I'm happy. I lost a lot of money on my SPY put option. I'm perfectly okay. Why? Because others are working for me. So that's the whole point. Okay. So what do? So you can look at the Feb 14 based on this scenario, 23rd of Jan 2014. So when you have the PowerPoint slides, just go through the case study. If you don't understand, let me know. Okay, so I picked the option that gives me the fastest double. You can see that, well, that is one way of doing things. The second way, of course, is you may want to just pick a delta of 30 options, so that you can actually pick a 159 put option too. So either way, to me, is okay, because your objective is you just expect the market will drop. Now, one thing that I would like to let you know, if the market is in a correction mode, do not expect the index to drop beyond 10%. So a lot of people thought, oh, market finally tanked. No, watch out for that 10% rule. Market dropped below within 10% is called correction. And according to William O'Neill, the founder of IBD, Investor Business Daily, that's called a healthy correction. So do not expect the market will tank. So this kind of money is, okay, you need to get fast. You need to take action fast. You cannot wait. Because when you are late, the next day, the market may snap back and your position will get hurt. Okay, so the example here is I choose Feb because Feb has 29 days. If I want to buy March, too far away, why do I want to buy a 57-day option for insurance? I'm overpaying my premium, so it doesn't make sense. So 162 put Feb 2014 this year for $235. I bought 4 contracts. The thing about this trade is that if the underlying drops, well, that's where the money comes. Otherwise, I will lose my premium. So that's the position where I have limited risk, but substantial reward. Of course, I don't expect the index to be 0, because if that happens, the economy or the world is over. A substantial reward means as long as the index drop 5%, 6%, or for that matter 10%, I'll make quite decent money on my insurance. Okay, so yes, you can wait for. This is a very interesting setup. What you want to do is you can use a swing high as a stop loss to watch out if the market snap back. Okay, and you trace above the swing high or close above the swing high, you exit your position. If it's dropping, then let it drop and let you make money accordingly. 2 days later, the market really tanked 2 times. So this is just to show you that the position doubled the money in 2 days. So these are the opportunities that you need to be very fast. Okay, so I'll let you study these slides. If you don't understand, let me know. Okay, I have 2 more minutes. So the potential challenge to you is the trade comes very fast. So you procrastinate, the trade will be gone. You need to remind yourself that if you make money on this kind of speculative insurance play, that means your portfolio might be hurt. So you need to understand this aspect. So I'm not very happy if I make money on my insurance. Okay. So can you sell all of the money call option? Well, of course you can. So this is really a premium collection play. So you sell an out of the money call at lower strike, buy an out of the money call at higher strike using same expirations options. So the question that I ask is, okay, if I'm looking at Dow Jones giving me that scenario on 23rd of Jan, I can say 2 things. One is I think Dow Jones is going down. Second thing is I think Dow Jones is not going up. So by asking the question in the second way, that is how I can generate the strategy. So the whole point is that you see this is a very risky strategy because the risk is too high. Okay, the reward is low. By the way, this is a short call. So people ask, why do I not short the call? Because short call can give me unlimited risk. So you always buy a call at the higher strike to hedge the position. so that now your risk is lower, but it's still quite high compared to your reward. This strategy, you notice that normally you will risk high and you get a low reward because of higher probability of success. Typically, we will sell an option. We will pick an option around delta 20. We don't want an options delta to be high because an option with delta 20 says that there's only a 20% chance the option will expire in the money at expiration. And I really want the option to expire worthless or out of the money. So 20 is good. Higher is no good. So what I want to do is I will sell 165 call and at the same time buy 166 call. So that will form a nice call vertical spread. And that's the risk graph. The risk graph says I've got a risk of $964 for 12 contracts, and my credit is 240. Now you look at per contract basis, you see that the call has a risk of $80, whereas the credit is only 20. So in other words, you are risking a very high amount for a low reward. And why do you still want to do this? It's because of the probability of success. What do I mean by probability of success? It simply means that there's a very high chance that the option that you have sold will expire out of the money, so you can keep the premium. So that's what delta is all about. So we are playing math. So trading plan, I'll let you read it because that is basically telling you that I'm holding on to a position all the way to expiration date. So on 31st Jan 2013, Dow Jones hovered around 157, and guess what? I bought back the spread. Okay, so I bought back the spread. I didn't really let go the spread, let the spread expire worthless or expire out of the money. As long as I see the spread can be bought back for 5 cents, why do I keep the spread? Whenever I can buy back the spread for 5 cents, I sold the spread for 20 cents. I bought back the spread for 5 cents, I keep 15. Now you may think, but the $15 only, it sucks. Well, that's the nature of premium trade. The reward is like that. Okay, that's why people then ask, do I want to trade diamond? Well, diamond will give you this kind of premium. So why not consider trading spider? Spider may generally give you a better payout. Okay, that's my intake. That's my insight. My final thought on bearish play. I like directional bearish play when there as an insurance, which I've just shown you, especially when I see a potential correction, using stochastic bearish divergence as a warning, and then using a trend line to see whether the trend is broken, you can do a very nice bearish play quite fast. I also like to sell call premium. Well, of course, in the broad market picture, sometimes I do that. Not in the recent months, because the recent months the market is heading up. So it's a bit risky, so wait. Correction is being corrected over the last few trading days. So if you are late, correction can be corrected. So that's the one that I've shown the batch 1 students. If you are late, you may get hurt in the position. So can you do the same for other stocks? Well, you can, but I do not recommend, because I'm a very simple man. I buy insurance that is highly affordable. I buy insurance that is popular. I don't buy insurance on specific stocks. For me, I only use spider, sometimes diamond, really, to do a portfolio hedge. That's it. Keep it simple. That's how you make money. Okay, my watch is now 22:04. That's the last slide. I am done. I can tell you, batch 1, I finished this session at almost 11. I have shown myself a fast improvement. I finished it at 22:04. Okay, so Andrew is in the room, so I unmute Andrew and just check whether he's fine. Any questions from Andrew before I call it a night? Okay, so Andrew, you can unmute yourself. If I muted you just now. You can unmute yourself. Yeah, I heard your voice.
Yeah, hi. Thanks, Jack. I think it's a very good resolution for me. At least now I see more things. Yeah.
Oh, okay, good. That's very good. You see more things.
Yeah, I think I need to practice more.
It's really practice. You see, the rules are very simple.
Yes.
Only if you practice.
Yeah,
And
right.
batch one, I thought I've given examples of URI, Save, as well as Qihoo, QIQ. QIQ is still my best winner of this year. Thousands of dollars just by following the system. So it can work. The question is that practice makes permanence. So if you can practice more, then the system will come. The things will come. Yeah, you're right. Practice more.
I think it needs to hands-on to get ourselves familiar with the platform and how to maneuver, navigate the platform. I think that's very important.
Yep, exactly.
You need to spend a lot of time on the trouble because we have our normal job to do. Then sometimes we may not be able to afford the time. I think that's the problem we face. Yeah.
Your challenge can be overcome by, let's say, give yourself just 5 minutes a night before the market open, if you can, and then just look at the charts. If there's setup, watch, pay attention to it. If no setup, then do your other things.
I see.
The setup can come very slow, and in the case of URI, for example, it came in only just recently. But when it comes in, it is very, very nice. So I waited for URI for 1 whole month already until recently something finally comes. So it is a question of being patient. You don't get set up every day. You don't get the signal every day. And sometimes it can be frustrating. So what I'm saying is that patience pays. Patience pays. Yeah, that's my insight.
In fact, for yesterday and today, I was trying to look at 3 IBD BOB stock. That
nothing happens.
Nothing happens.
Yeah, so you just have to wait. So batch 2 students will have the same question. So I've got this BOB stock, the Bob stock we call, but no signals. Then what do we do? WAIT, wait. There's nothing you can do. You just wait. Yeah, that's what the system said. The technical is not there, so I'm not going to force myself for a trade. That's the nature.
Wait,
I can't.
Our demo account and all this.
Yeah, demo account, whatever works for you, I'm okay. The whole point is that if you can practice more, you will know that the power. You will appreciate the power of the system.
Right. There's one question, Jack. Because recently I got a problem with my credit card. My credit card was cancelled, and then they issued me a new credit card. That's why my option analysis account was suspended. So when I tried to open the account again, so they asked me for the promo code. Can I still use the promo 50 to go in?
Yep, use promo 50. If you can give them a new email address.
Must have a new email address. Cannot use the same email address.
I was told that you cannot use the same email address.
Oh, I see.
So you may need to use a new email address for that.
Okay.
Okay.
Thanks a lot.
Okay, no problem. Okay, good night. Bye. So guys, I'm also exiting. So see you in next session. Session 3 will take place on Monday, 9th of June. So I'll upload the video as soon as possible. Okay, bye.